Most retirement experts and financial planners recommend saving 15% of your annual income towards retirement, putting that money into your 401k. But it is not enough just to save money. The allocation in it really does make a big difference. And that's what we're going to be looking at in today's video. Exactly when you work for decades at a 9-to-5 job and you get ready to leave that job, when you start looking at your 20s, 30s, 40s, 50s, all of the years and all of those working years before you get into retirement, it is really going to make a game-changing difference how the money is invested, not only making the regular contributions over an extended amount of time, but in today's video, we're going to be looking at the asset allocation using my 3 ETF portfolio. And of course, this is going to be based on age. Now, if you're 20 years old, it's going to look a lot different than if you're 50 years old, kind of getting into retirement. Now, a lot of people look at stocks, look at ETFs, look at bonds, look at cash, look at gold, cryptocurrency, real estate. There are so many investment portfolios, but we can simplify it with just 3 very basic, simple ETFs. And when you start looking at the extended amount of time that we have seen these returns, it is kind of crazy. So let's hop over and we'll take a look at it. All right, guys, so here we are over on M1 Finance. Now, I do have a referral link down below if you want to check it out, but you can see the details of the 3 fund portfolio. Now, there's a couple different ways that we can do this, but you can see that this portfolio is made of 3 specific ETFs, and I want to run through those before we show you the age allocation kind of each one of these. Number 1 being the Vanguard High Yield Dividend. This is the VYM, as you can see right there. So this is going to be our dividend. The VYM, of course, is a dividend driven ETF, which means you're going to have a pretty good yield out of there, which is what we want when you're at the age of actually generating income and making sure that the stability is there. You're not going to have as much volatility as you get closer to retirement. Then we have the VGT. Now, this is the information technology. This is going to be the growth ETF. Now, this, of course, is going to be the one when you're at a much younger age. This is going to be the ETF that you're going to put a majority of your money into, because essentially, let's say you're 20 years old, you're retiring at 65, you have 45 years of growth to go ahead and really take some risks, and take some risks early with what you're putting in there. And also, when you think of the younger age, you're going to have a lot lower balances in these accounts, which means the up and downs are going to come with time. But as long as you're sticking to that 15% plan of putting money into the 401k, it is going to be a game changer. And then the last one we look at is the Vanguard Total Stock Market. Now, this is the VTI. So instead of doing the VTI, you could do the VOO, which is the Vanguard S&P 500. This one is the total stock market. So this is every single stock we have in the United States stock market, in the stock exchange. It is really interesting. There's like 3,800 stocks in here. So when you look at all 3 of these, the diversification for these ETFs are built in automatically. Now, why do I say that? Because when you start looking them, we have a couple different sectors, we have a couple different industries, even looking at the VTI that covers everything in its entirety. And again, the allocation that you see in these is going to make a difference. So we're going to start off, of course, with the basics. Beginning retirement plan when you're 20 years old. This is going to be the high risk. This is going to be the VGT. This is where probably 90% of your portfolio is going to be. Even if you split it among these other 2, even doing 5 in a high yield, maybe 5 in a total stock market. Even if you're 20 years old, you could go ahead and do something like just investing in the VGT. Because again, we're looking for a lot more of the growth, and we're looking for a lot more of the growth at a much younger age. So when you start your first job, putting everything into something that has the ability to grow, again, there's going to be ups and downs. But when you look at the overall return with the VGT, when you start looking at the tech companies, the mega cap, really tech companies, when you look at artificial intelligence, when you look at the chips, the VGT has performed exceptionally well for an extended amount of time, which again is a reason why it is a good buy when you're starting. Now, traditionally, these portfolios kind of run a different kind of build, because most people do invest in bonds. Now, me personally, there are 2 things that I do not do as a financial counselor. Now, I'm not a financial advisor, and of course, we're over here on YouTube making these videos. But when you look at the picture, when you think of big picture, I do not invest in bonds, and I do not invest in the international market. I don't know enough about it. I don't do enough research about it. When it comes to international stocks and bonds, even ETFs, I choose not to, because of my own preference, to only invest in the United States. And again, I do not invest in bonds. Even when you look at about a 10-year return of the BND, it is yielding about a 2, maybe 2.5% over a 10-year period, which again is kind of crazy to think, because of course that is very, very low. So again, even if you did a 95.5, even if you put whatever you started with into the VG itself, it would work incredibly well. And of course, looking at this one, you could choose the QQQM. You could go a couple different ways. You could do the V. There are a couple different ways that you could really do the growth ETF. So definitely make sure that you're doing your own research. Now, when you started getting into your 30s, this is where majority of people are kind of out of the regular jobs here and there, maybe hopping around, maybe they're done with school. You're starting to get a little bit more into what you do in life. You start getting into kind of the career path of what you're going to do. If you've got a 4-year degree, a 6-year degree, whatever it may be, when you start looking at your 30 to 40s, this is really the career focus. This is the time when a majority of individuals start really climbing that corporate ladder. This is where you kind of pull it back just a little bit. So even here, if you did, let's say 80% in something like this, and then you even built it to a 10 and a 10, would be really beneficial. Because again, when you think of the 30 to 40s, okay, well, we still want a lot of growth. You still have a massive runway when it comes to really building this out. And again, thinking about the portfolio, if we have a majority of it kind of in that growth portfolio, that growth section, you're still going to see some growth and you still want to see some considerable growth. You have a little bit more exposure onto a core ETF like the VTI, which of course is going to be invested in the total index itself. And then the high yield dividend is bringing you in a little bit of money because there is the dividend return in there. And again, when you start looking at this, the high yield dividend has a lot less of a fluctuation when it comes to the overall portfolio, and the information technology can be up and down. And then the stock market, the VTI, can be more ups and downs, but not quite as high as the VGT. Then you start getting into your 40s. This is where a majority of individuals, including myself, really start buckling down, really start thinking of the retirement aspect in there. And again, it's interesting to see because this is where a lot of people do exactly that. So looking at this, you could do like a 70, 60, 70 in here. Even if we went 70 in here, you could do 15, 15. I might even go ahead and put a little bit more just into the total stock market because again, we're still looking for some growth. The VGT is still doing incredibly well. And at this point, when you think of your 40s, so let's say for instance, you're 40 years old, you have already had this portfolio, you have been making your 15% contributions, and you have been doing this for 20 years. At this point, we are already 20 years down the pipeline. And of course, you're already starting to see a lot of balances. We're starting to see a lot of that compounding snowball going on. And ultimately, this is the portfolio that you want to build. And again, if you stuck with this for an extended amount of time, this portfolio would do incredibly well. And even looking historically, if you went back to certain dates, let's say the last 50 years, depending on when these funds come out, I don't think some of them were around 50 years ago. But when you start looking at the S&P 500, when you start looking at a lot of the Vanguard funds, they have a super low cost, which is what a lot of people do love. They are almost all the Vanguard funds have a very, very low cost. And of course, they perform exceptionally well. So then we get out of the 40s and we're into the 50s. This again is a plan when a majority of people are really starting to get into that retirement phase. So even looking at putting, let's say 60% here, we could do another 20 here. And there we go. There's our 100% allocation. So what you can really take from this is when you're going through, depending on your age, because now we're 50 years old, we know we probably have 10, 15, maybe 20 years till retirement. We're starting to pull back a lot more on the information technology. We're starting to pull back a lot more of the volatility and starting to put more into those high yield dividends, starting to put more into the actual stock market. So again, we kind of start pulling it back a little bit further. And then when you get into the 60s, even down to the 60s, I mean, it might even be a point where, hey, I am looking at retirement. Let's do like 40% in here. And then even looking possibly doing like a 30-30 split. You can see we're getting a lot more out of the volatility, out of the information technology, out of the growth ETFs. Now, of course, this is where I feel like a lot of people really miss the boat when it comes to investing, when it comes to actually looking at the growth factor. So you think right now, for instance, you're 60 years old. So boom, you're 60 years old, you're ready to retire. Average age of a male is 87. You still have 27 years. That is right. If you're 60 years old, you're living to 87. You have 27 years that this investment portfolio or whatever you have for retirement has to carry you financially as your supplement to Social Security, which I feel like, again, a lot of people do kind of fall short. But when you're getting into retirement, even looking at something, again, like the VUG, the VGT, the QQQM, something that is going to be a bigger growth portfolio, maybe even once you hit retirement, you put this at about 30%, that would be pretty good. Now, of course, this is going to be depending on your needs. That is one of the big things. So again, when you think of Social Security, when you think big picture, Social Security replaces about 40% of your income. So at this point, and again, instead of having the bonds that are going to go ahead and generate you a little bit of income, we are using the VYM or the HD, the JEPI, whatever you want to generate income. So even at this point, looking at our other contribution, this might be 40%. And again, this is going to be very dependent on you. Because if you're getting to the point of retirement, you have a pension, you might have Social Security, there might be a couple different avenues of income that you're not reliant on this income. If that is the case, and I'm sitting on a portfolio right here that I do not need the income, if I'm sitting on something, it might behoove me to put a little bit more into kind of the entire market, maybe a little bit more into the growth, if there is no anticipation to the income generation that I need in here. Now, of course, again, thinking of the HD, the JEPI, the VYM, if there is a requirement, if there is a need for dividend income when it comes to retirement, this would be the way to do it. If you're putting a good chunk of the portfolio, and again, let's say I'm kind of reliant on some dividends, I'm reliant on really the building of this and seeing what it is, because I need income to supplement my Social Security. I can put more into a high yield dividend, which is going to pay me quarterly. JEPI pays you on a monthly basis. HD pays you on a quarterly basis. But essentially, I'm going to use the dividends generated from this portfolio to cover my bills. This is going to be my paycheck that I get every quarter. And of course, this is going to be really, really important. Again, depending on your situation, depending exactly where you are. And then of course, if you're really struggling, you could put more into the income. If you're not planning to use it, still getting the growth out of there, still getting the total stock market 3 ETF portfolio. And now looking at this in the allocation, guys, it is super easy. It is very, very easy when you start getting in here. And again, the old one does kind of look at using bonds. I don't agree with the bond play. Even talking and working with financial advisors, I really don't agree with the bonds. I don't agree with the return of bonds, because a lot of sites even say that upon retirement, you should have probably 60 to 70% of your entire portfolio into bonds, which means if you're moving 60 or 70% of that portfolio into bonds, you're going to get about a 2.5% return, which is regular in bonds, which means that if we have inflation at 3%, 6%, 7%, whatever inflation is, if you're only getting 2.5% return, you are literally losing money by parking money into your bonds, which again can be very detrimental for retirement. So I feel like there is a point where, yes, you don't want a ton of volatility, which something like a Vanguard, again, looking at some of the higher dividend yields, they don't have a ton of volatility, but they are still going to generate income depending on what exactly your needs are. So what is the bottom line with this, guys? The best time to plant a tree is 20 years ago. The second best time is right now. That is right. That is a very, very cool Chinese proverb, because you think, if you're starting at 20, it's going to look different than if you're starting at 30. If you're starting at 40, 50 to start saving for retirement, you're already, 10, 20, 30 years behind the curve of where you should have started when you started that first job. And of course, if you're like me and you're putting 15% into the investment portfolio, it is going to grow exponentially. I mean, when you start getting 100,000 in there, when you start hitting the 500,000 mark, the snowball effect with contributions is insane. When you look at the growth, even when you get a compound impact or compound interest calculator, it is a game changer when you look at how much is really going on there. And of course, how much you can get out of these portfolios. It is incredible to see the growth rate. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.